of not-for-profit financial reporting is simplified and so go ahead, Michael.
So good afternoon, everyone. I hope you've enjoyed the first day of the conference so far. I know we're fairly late in the afternoon, so energy levels might be dropping a bit. I'm going to talk a little bit about accounting standards, so I don't know whether that's actually going to make the energy levels better or worse. So just bear with me. So I'm going to talk a little bit for about the next 20 minutes just on the future of financial reporting. So the Australian Accounting Standards Board has released, I'm just wondering where I should stand here, so I'm not in the way, has released an exposure draft about a new accounting standard for not-for-profits, so for certain not-for-profits. So we're just going to talk a little bit about that. And while I go through that, I just want you to bear in mind the question I've just got up there is simplified a misnomer. And I'll explain that sort of as we go through. So before we start, I guess I'll just explain and just introduce myself. So my name is Michael Fay. I'm an Executive Director with Pitcher Partners in Perth. So if you're not sure who Pitcher Partners are, just to give you a bit of context so you know who is talking. So Pitcher Partners are a full service offering professional services firm focusing on the middle market. So I'm in the audit department, and my portfolio covers a wide range of organisations, but probably about 75% are not-for-profit. So, you know, this sort of area is really interesting to me and my clients. So that's why I sort of get really excited about it. Thanks, David. So hopefully you guys find it interesting as well. Before we go into too much detail, I've got to give the standard disclaimer, okay? So anything I say today is just my personal view, okay? It's not the firm's view, it's not anybody else's view. And the reason I say that is because, as I'll explain, the exposure draft is a bit of a process in terms of formulating formal responses back to the Accounting Standards Board. So Pitcher Partners is going through that process at the moment. So when we actually finalise what our views are, they might be different to what I'm saying today, right? So I'm just saying, just take that in mind. Also, the AAXB have actually been really good and really proactive, and they've released a lot of information about this exposure draft. So rather than reinventing the wheel, I've sort of stolen a little bit of their stuff to put on my slides as well. So just full disclosure, okay. So what we're going to touch on today is I'm going to go through and just give you, I guess, a little bit of a background as to, well, what is the current status of play? What is the current status of play? So why are we actually talking about this exposure draft? Why is that actually there? What is the aim of the paper? Who's going to be affected? Then we'll go into a little bit of the detail, because at the end of the day, the devil is in the detail. So what is it that's actually going to be required? And then, because as I said, it is a bit of a process, so the AASB do want feedback. So it's about how can the sector actually provide that feedback and where to go for more information. So that's just what we're going to have to cover today. And that'll probably take us about 20 minutes, and then hopefully have some questions. So look, I don't know necessarily the background of all you guys, so I do apologise if I'm either being too basic or too sort of complex, if you know what I mean. So just bear with me. But just to give a little bit of background, there are lots of different types of not-for-profit organisations, obviously. We'll pick two of the most common ones: charities and associations. And now, yes, you can have an association as a charity as well, but just for the purpose of this, we're just sort of keeping them separate. So if you're a charity, as you probably know, you're governed by the Australian Charities Not-for-Profits Commission under the Australian Charities Not-for-Profits Commission Act. If you're an association in WA, then you're governed by the Government of Western Australian Mines, Department of Mines Industry Regulation and Safety under the Associations and Corporations Act. Now, there are different types of reporting requirements under both of those organisations, but fundamentally that is based on the size of the organisation. So if you're larger, there's probably more financial reporting requirements. If you're smaller, there's less. But fundamentally, if you are required to prepare financial statements by those two organisations under those two acts, you have to be in compliance with Australian accounting standards. Okay. So what does that mean? So Australian accounting standards, there's a whole suite of Australian accounting standards that cover all the different aspects of financial reporting and accounting, as you're probably aware. They can be quite complex. There's a lot of judgment involved, and obviously they change over time. So we've gone through a real period of change over the last 4 or 5 years, where there's been some big fundamental changes to how we account for things. So the leases standard, which I'll touch on, the revenue standard, and then the income of not-for-profits, which I'll come on to later as well. So fundamentally, if you're a small not-for-profit organisation and you've got to comply with Australian accounting standards, that can be quite difficult. You may only have a bookkeeper, you may only have a couple of admin people. It gets really hard when there's complex requirements, there's judgment involved, and it just can be difficult. So the AASB, to be fair, they don't want to make life difficult, and this is why I sort of put is simplified a misnomer. And I apologise if anyone is connected with the AASB or married to somebody that is. So this is just tongue in cheek. Quite often for the AASB, when they talk about simplified, what they actually mean is make things harder. But in this instance, they're actually trying to do the right thing, okay? They've got feedback from the sector. They know that some of these accounting requirements are pretty complex and pretty difficult. So what they're actually trying to do is make life easier for those smaller entities. So they've released this exposure draft, which talks about a tier 3 reporting framework. Now, just to put some context into that, there's tier 1 and tier 2 at the current time. So tier 1 is basically what we call all the measurement and recognition criteria of Australian accounting standards and the disclosure requirements. Tier 2 is all the measurement and recognition criteria, but less of the disclosure requirements, okay? So if you just think about size, the larger charities, the larger organisations, they've got to do everything, then you sort of drop down a tier. So then the AASB are talking, okay, what about those entities that are down here in terms of size? Can we do something that's actually going to help them? So the purpose of that is actually to reduce the cost, reduce the burden of actually preparing those financial statements. Again, thinking about what I said, that a lot of organisations only have a bookkeeper or, just a part-time sort of accountant. They also want to bring in some consistency in terms of recognition and measurement, because at the moment, if you're a smaller organisation, you can potentially choose what you do. And also to meet the needs of users. So do we need all this suite of financial statements as well, all the complex accounting in there? Do we actually need that? One of the other things that they wanted to do, or they're proposing to do, is remove the ability to prepare special purpose financials. Now, I wasn't necessarily going to explain what special purpose financials are, so I do apologise if that doesn't make any sense to you. But at the moment, you can prepare general or special purpose. Again, think of it, general purpose being the full-blown everything, special purpose being a lot less requirements. So in the for-profit world, they've got rid of special purpose, that you can no longer do that. And there has been talk for some time about trying to do that in the not-for-profit world as well. So at the moment, not-for-profits can still prepare special purpose. But again, it's all about consistency. And the final thing is, I talked about the suite of accounting standards. So what they want to do is they want to sweep those off the table and go to replace that. Here you go. Here's one standard. Here's one standard that covers the measurement and recognition requirements. Here's one standard that covers the disclosure requirements. So it's just a go-to Bible, I guess, and trying to make it simplified. So that's really what they want to do. What they don't want to do at the moment are these things. So they don't want to introduce or develop any service performance reporting requirements. They really just want to focus on the financials. So nothing about the reporting in the financials about what the organisation actually does. They don't want to establish a reporting threshold, so they're not going to say, well, at this size you've got to do this, at this size you've got to do that. I touched on the tier 1 and tier 2, so they want to leave those alone. They don't want to touch those. And then also, if you think about it, also really what we're talking about is size of organisations. And we're talking about a particular group of people, which we'll come on to. So what they're saying is, yes, on this scale, okay, we've got tier 1, tier 2, we're talking about tier 3. Of course, there's going to be organisations below that as well, that are smaller, but at the moment, there isn't a plan to sort of do anything with those guys. So they just want to make it clear as to what is it they're actually doing and what is it they're actually not doing. So coming on to that, so we talked a little bit about the why, I guess, and the reason behind that. So the who. In a nutshell, it's those smaller not-for-profit organisations, and the guide is the revenue between $500,000 and $3 million, because that's really the area where they go, okay, well, those organisations don't have full finance teams. They're not as big as, the varieties or the sort of national RSPCAs and those sorts of things. So they're the ones that we really want to help. If you're familiar with this space, the ACNC have changed or recently changed their reporting requirements as well. So again, they've acknowledged that, okay, the burden on preparers just preparing financial information is quite high, and we want to try and reduce that. So I guess all the regulators are trying to work together just to make life easier and more sort of beneficial for those types of people. So if we just sort of keep that in mind, that they are the people that we're talking about, those types of entities. So then we come on to, okay, that's fine, that's the background, that's all the information, but what is it we're actually talking about? What's going to change? What's going to happen? So there's a whole heap of things that they are proposing, and I don't intend to sort of go through all of those. It's all in the exposure draft like this that you can go through. But what I wanted to do is pick out a couple of things that are relevant, because what we're really talking about here is we're talking about a different framework for measurement and recognition. So we're talking about sort of stripping out these organisations, putting them over here and saying you can do things completely different to what other organisations do. So it's a really interesting, real fundamental change in what we're doing. So for example, consolidation. So you might have a not-for-profit organisation that has a subsidiary. If they need to prepare financials in accordance with accounting standards, then at the moment they need to apply the consolidation standard and consolidate that entity. So what the AASB are saying here is, well, actually, we're going to give you a policy choice. We're going to say you can either do that or not do that if you want to. I imagine most people are not going to do that. But if you don't do that, then potentially there's a little bit of disclosure that you need to do. So that is really different to a lot of other organisations. So you're potentially going to have all these organisations out there that don't consolidate subsidiaries when previously they would have had to. So that's quite interesting. Some other big changes, and AASB haven't shied away from trying to make big changes. Quite often when they tweet things, they go, yeah, we're going to make sweeping changes and we'll tweet this, we'll tweet this, and we'll tweet this. And in the end, it ends up being pretty much the same. But this is really sort of fundamental. So you may be familiar with AASB 16, which is the leases standard. So that came out probably about 4 years ago. And the aim of that was to bring on the balance sheet any off-balance sheet financing. So if you had an operating lease, so you were leasing some equipment, previously you just put the payments through the income statement and there'd be nothing on the balance sheet relating to that because we don't own the asset. So they changed that and they said, well, actually, you've got a right to use that asset and you've got this contract which says you've got to make these payments over a period of time. We want that on the balance sheet. So it caused a lot of pain, caused a lot of fundamental changes in the way that people see things, but it's all been bedded down now, okay? So people are pretty sort of comfortable with that. Not-for-profits, they're also recognising everything on the balance sheet. Notwithstanding that there's a bit of a concessional arrangement around whether they've got peppercorn leases or not, you can still recognise those at cost or at fair value. So you do get a bit of a choice there. But what the exposure draft is saying is, no, let's reverse all that. We're going to change our mind. We're going to undo all that good work. And we're going to say you can just go back to doing what you used to do. So I don't know whether, my personal view, I don't know whether that's a good thing or not, but we'll see. But it is a fundamental change and it is something that's going to make life. Also on the employee benefits, at the moment, if you've got annual leave and long service leave that isn't going to be settled or isn't going to be paid out within 12 months, that is classed as a long-term liability. You've got to then gross that up to the time that you think you're going to make that payment and present value it back. Now, that is a bit of a accounting sort of tweak. A lot of the not-for-profits we're talking about, they don't necessarily have the skills and experience to do that. So I find that that's quite a common audit adjustment that we have to do. But this exposure draft is basically saying, no, forget all that as well. You don't need to do any of that magic stuff. Just recognise it and undiscounted amount. So again, we're moving away from this comparability to with other organisations. And really what we're trying to do is go back to, I guess, what you call cash accounting at the end of the day. It's just what is your income, what is your expenditure. Let's not worry too much about this funny accounting magic that can happen. The really interesting one I want to talk about, the one that I think is going to make a big difference is this one. To give a little bit of context, let's go back about 4 years. So the AASB acknowledged that the income of not-for-profits is very different to commercial organisations, so that they probably needed their own accounting standard that's going to help them. Now, the theory behind this is great. This is where I sort of tongue-in-cheek is simplified a misnomer, because the reality of this particular standard, or the original standard, AASB 105A, is it actually makes things a lot more complicated. So if you've got an organisation, so you've got a small not-for-profit down the road, you know, they might have some donations, they might have some bequests, they might have, let's say, 5 to 10 funding agreements. One might be a sponsorship agreement, others might be just from the government. That's a lot of different sources of income. Let's take Amazon, for example. Okay, so Amazon do lots of different things, but let's just say they sell books. All right, so somebody orders a book, the book's over here, you've got your payment over here. There's this point where they just cross and everyone lets go, and you go, right, that's when the revenue recognition happens. Okay, so this is a multinational, multi-billion-dollar business that revenue recognition can be resolved in 2 seconds. You've got this small not-for-profit down the road where they've actually got to go through each of these agreements and work out what happens. So the concept of 105A is basically around control. When do you actually control that funding? So if you've got a donation, for example, or a bequest, probably there's no enforceable agreement there. There's probably no transfer of goods or services, and there's probably no performance obligations. So pretty much you don't need to do anything for the money, it's just given to you. If that's the case, that needs to be recognised immediately because we control the money now. If you've got a funding agreement that says, okay, you've got to do something, then you might have an enforceable agreement. It depends what the contract says. You might have a transfer of goods or services. And think about that sponsorship arrangement I talked about. If the funding provider says, you've got to put our logo on your website, on your event, is that a transfer of goods or services? What are we actually transferring? What are we actually doing? And then what are our performance obligations? Are they what we call sufficiently specific? So it gets really complicated. And if you've got 5 or 6 of these agreements, and you basically got a part-time bookkeeper, how can you possibly work through all of these things and know what the right answer is? All the agreements are written differently. All the terminology is different. Are we lawyers to interpret that information? No, we're not. And you could give the contract to me and then give it to one of my colleagues that's got equal experience and equal knowledge, and we could come up with different answers, right? So the AASB have acknowledged that, and they've said, okay, well, maybe what we intended didn't necessarily actually, it hasn't actually been what's happened. So we're going to strip that back, and we're going to introduce a new model where we talk about a common understanding. So if we've got a common understanding between the funding provider and the person that's receiving the funds, and you can evidence that, well, hey, both of you understand what's going to happen or needs to happen, so let's just recognise revenue based on that. So I think that actually is going to really simplify things and really change things. So no longer will we have to go through all these different clauses and terminology and work out what it says and what it means and get lawyers involved in interpretations and things like that. We can just go, hey, what do you guys understand needs to happen? Is that evidence? And let's go on that basis. So that is actually going to really, really work. So is this a fundamental change in the accounting? Not really, but just the way that we approach it is. So I think this one is the one that I think is going to make a big difference and it's going to be really good. So I look forward to seeing that one come in, I think. So that's a little bit about the measurement and recognition. There is a whole lot more that's in the exposure draft and talks about other different things like financial instruments and what's actually in there and what's not in there and what gets covered and what doesn't get covered. So yeah, the aim wasn't to sort of go through those, but it was just to show you as an example that there are some fundamental changes in this particular standard that we're talking about, which is really going to effectively have a differentiation in terms of the financial reporting framework. So then we come on to, well, what is in play at the moment? So going back to what we've got at the moment, and you go, okay, if I've got an organisation that now fits into this bracket that previously has been recording all its leases on the balance sheet, it's been present valuing all its liabilities, it's been following all the accounting standards, but now we fall into this framework, which says, hey, don't do any of that anymore, we're just going to go back to normal. What if the organisation says, no, actually, I just want to carry on doing what I was doing? Yeah. So the AASB are thinking about that, and they're going, okay, well, how do we deal with that? So as it says there, can you opt out? Can you choose to just carry on and do a tier 1 or tier 2 financial reporting framework if that's what you want? Or is the AASB going to say, yeah, you can do that whenever you want? Or are they going to say, yeah, you can do that, but only in certain times when we say you can do that? Or are they just going to say, no, look, you can't do that. If you're in tier 3, that's it, end of story. So they are working through that. And it'd be really interesting to see what happens from a transition perspective if you have been applying all the full accounting standards and then you want to transition into this new standard and de-recognise some of those assets and liabilities or change the way that you account for things. So there is going to be a little bit of a transition that happens there. But I don't think they've actually settled on what the answer is to that. So we talked a little bit about measurement and recognition. So obviously there's the other side of accounting, which is the disclosures. So what is in the financials? So this talks about, okay, if we've got a difference in the measurement and recognition from tier 2 to tier 3, how do we deal with that? So if there's no difference, it's basically just saying just follow all the old disclosures, that's all good. If it is different, well, is there something else in the world that's going to help us work out what we actually need to disclose? And if there is, do we need to come up with something new? So they're working through that as well. So there is a little bit of work still to do just to find out, what's going to happen with the disclosure side of things. So I guess that's really in a nutshell, that's it in terms of very high level around what this exposure draft means and what it's going to sort of look like. So going back to the original question, is it simplified a misnomer? In this instance, I don't actually think it is. I think the aim of the AASB is a genuine aim, is to try and help people, is to try and help those small and not-for-profits. And I think introducing this standard is actually going to help them. I did talk about earlier on that it's a process. So as with everything, they release an exposure draft, they ask the sector for feedback, they take on board that feedback and they either ignore it or they actually take it on board, and then they release the actual accounting standard. So what they're doing is they're in the process now of asking for feedback. So if you are interested in going through that and providing some feedback, then there are certain ways that you can do that. Online survey, you can email them, similar to what the accounting profession is doing the formal submissions. or they have what they call virtual outreach sessions, which are effectively just round tables. So talking about round tables, Pitcher Partners and the UWA Centre for Public Value with David, we're planning to hold some roundtables in the new year. So if you are interested in attending those, just to talk about what these changes are, we can formulate some feedback to give back to the Accounting Standards Board, then either please reach out to me at Pitcher Partners or David through the UWA Business School. You can also, this is going to be, final thing, in terms of more information. So as I said, from our perspective, Pitcher Partners, we're like everybody else. We're still working through this. We're still working through what it's going to look like, and until we know what the final version looks like, it's very hard to provide the thought leadership and all that sort of stuff. So the WSB are probably the best place to go to because they're ahead of everybody else. So there's a lot of information that you can go and have a look at, and it just talks about this sort of stuff in more detail. So if you are interested, I would advise to go to the WSB. Final thing is, if you did want to talk about anything we've said today or I've said today, then please feel free to contact me. You can do that, just call me at the office or whatever. Happy to have a chat because we have gone through things very quickly and it's very high level. So there's a lot of detail there that we sort of missed out. And then, that was it really. So then just to sort of ask if anybody's got any questions around anything we've touched on today.
Well, first of all, I want to say thanks. We leave questions to the end, so
Okay,
it might be the next two presentations.
Yeah, sure.
We'll have
That's fine.
questions
All good.
All
Yeah,
right.
good. All right. Thanks, guys. Thank you.
Thank you. So our next presenter is Ushi, who is presenting a paper with Craig Ghoorah, Financial Literacy and Information Needs, an investigation of individual donors' perceptions. Thank you, Belinda.
So I would like to acknowledge the traditional owners of the land and pay my respect to the past, present, and future elders. It's been a bit late. Sorry. Okay, so this paper is really at its initial stage, and we would really appreciate if we could get some feedback about the idea of the paper itself, the conceptual framework we're proposing to use, and the research method we have added. Like most of you would know in this room, the main objective of most regulators in the sector has been around building or developing, or you want to say restoring public confidence and trust in the operation of not-for-profit organisations. And to achieve that objective, they put a lot of emphasis on accountability and transparency by not-for-profit organisations themselves. We've seen over the years, we've tried to simplify the reporting requirements and guidelines for the sector. We've tried to encourage them to be more transparent. And in the last few years, we've seen the introduction of tier reporting, both in New Zealand, and they're thinking of using that idea in Australia as well. But we haven't yet seen much of an emphasis on users' needs, who users are, what information they actually find useful when they make decisions. But literature does acknowledge that not-for-profit stakeholders would be able to use, or they do find a certain level of value in information that assists the economic decisions. But literature does also acknowledge that not-for-profit organisations face pressures to be more transparent, especially around the fund flows, so fund inflows and outflows, and also around the effectiveness with which we've achieved a social mission. But most of the studies tend to take that organisational perspective. They look at disclosures from what is the organisation doing, how can they do it, but they don't really look at users' information needs. There's been 2 studies by Conley and Hedman, and we've tried to look at how organisations address information needs, and we've also developed a framework of stakeholder-focused reporting, but yet we don't look at individual stakeholder information needs. there's been like information that gets published out there by not-for-profit organization and how donors use information like financial and non-financial, and it's been looked at by McDowell and others in 2013. We had a study by Hashke, Levanto and Foot, which looked at disclosures and its ability to attract donations. And in this study, so the study by Hashke and Levanto, they eventually concluded that donors either do not care about disclosures or they are not aware that they can use disclosures for decision making. And we did think this was in contrast by the study by Ghoorah and others, where they found significant links between donors' perceptions of financial disclosures and their donation intentions. So the question remains whether individual donors' attitudes and financial literacy actually influence the perception of a decision usefulness of financial disclosures. There have been calls in the literature for more studies to look at information needs, both for funders and donors, but there hasn't been any study that actually looked at them over from Yang and others. Yang's study focused on funders' information needs. So they looked at the government and institutional donors. That gap still remains in terms of individual donors. And by looking at the relationship between donors' attitudes, financial literacy, and their information needs, the study will be contributing to the literature. Why we focus on individual donors, one is, of course, the gap in the literature. It's an academic paper, but also because individual donors remain a key stakeholder groups for the sector, and a vast majority of not-for-profit organizations are still highly dependent on individual donors. So we've got this small proportion of players in the sector that receive funding from institutional funders, but the majority still rely on individual donors. The literature sees that there is an interest in how donation has been used by individual organizations, and individual donors tend to prefer non-financial disclosures to financial disclosures. But there are limitations with non-financial disclosures, especially when it comes to how donation was used and the impact of that organization. For example, it's a sector where there's limited guidance and skills in terms of narrative reporting, social impact reporting. It can be also hard to identify outcomes over different time periods. So what has been the impact over time? It could be hard to isolate this different impact from one organization to the other when they might be operating in the same sector and it might be all interrelated, and also to segregate the activities that one organization undertakes from those activities that actually lead to that impact. So our focus is on financial disclosures, because at the end of the day, it is more specific about the allocation of funds by non-financial disclosures. No matter what type of other information out there, financial information does remain a key element of information that resource providers need from not-for-profit organization, and it remains a key mechanism for which organizations communicate with their stakeholders. The model we are proposing to use is actually the comprehensive model of information seeking. It's a model that was introduced by Johnson and Meschke in 1993. So it's a fairly recent model, and it's a model that was specifically developed to look at information seeking behaviors. It's being used extensively in the health context, and there has been calls in the literature to actually adapt it or to broaden the application of that model. So we did feel it's a bit relevant, and we are trying to do that. But yeah, so the model itself is made up of three components. The first one is antecedents, and then we have information carriers and information seeking actions. With antecedent, it's mainly looking at factors that would actually motivate someone to look for information. And it tends to look at demographic characteristics of an individual. with information carriers, it's looking at what shapes that information search. So it's looking at factors that would actually make an individual perceive a source of information as being credible, as being formal, as being accessible, and that would influence their information search and their information needs. And the last one is information seeking actions. So it's looking at the extent and depth of that search. So it's also about the extent and depth of information available, and that influences their search and information needs. In terms of hypotheses, we are proposing 4 main hypotheses. The first one relates to financial literacy. The literature on financial literacy itself is pretty limited. So we had to look a bit beyond the accounting literature, and most of the studies that did look at information needs outside of the accounting literature looked at the relationship between education level and information needs. And based on what we found there, we propose that the higher the financial literacy of an individual, the greater the appreciation of financial disclosures, and therefore the greater the perception of a decision usefulness of financial statement items published by not-for-profit organizations. Then the next 3 hypotheses relate to the attitude that an individual has towards not-for-profit organizations. So we've looked at trust in not-for-profit financial information, and the main idea here is financial, by being transparent and accountable, a not-for-profit organization is signaling that, okay, it's ready to provide information and to let people know how it's used its fund, how it's achieved its objective, or why it could not achieve its objective. So reporting on its achievement and failures at the same time. And by doing that, you create or you reinforce trust in that sector. And that leads to the second hypothesis. With the last one, so we've looked at value informal sources of information, and financial information tend to represent information that people have this perception that it's information that abides with accounting standards. It's following like a specific format, so it's a bit more reliable, more trustworthy than information that's not being prepared as per the standard format and following accounting standard. And that's how we came up with the next hypothesis. To actually test those hypotheses, so we collected data using a survey questionnaire. It was emailed to roughly a random sample of about 1,300 panelists in the second half of 2017. And eventually, after removing, incomplete responses, we ended up with a sample of 400 respondents. So I'll let Craig continue to progress.
10 minutes.
So in terms of data cleaning, the data was checked for normality and found the scale errors were surprisingly quite acceptable. Where respondents responded, I don't know, out of the like scale, they were moved to a missing data because 0 is not the same thing as don't like. And we got rid of outliers, which resulted in 398 valid responses. So this is the final model. We're looking at decision usefulness, a series of measures around that, and then a series of dependent variables, financial literacy and trust in the information. So trust in the information is different to the information itself. The value of formal versus informal sources and obligations to report. So there's a perception that if charities have to report, do they therefore trust the information. So this is the dependent variables. So financial information which provides, which is effective in achieving the results. Information which is about the organisation spends these spends its resources on agreed objectives, net profit and loss, that it follows the accounting standards. It's spending a percentage of its income, the cash minus cash out, and also the final one which you can't read.
Sorry, you can just put that down.
I was trying to rush through.
Thank you, sorry.
And then the accounting standards in the for-profit sector. So there's a differentiation made there. In terms of the objective tests, we need to do some data reduction. So basically, in terms of the objective test for financial literacy, we used K-means clusters to reduce 4 clusters. Basically, we ended up with an assessment about how literate are people. And we ended up with some people who basically failed every single objective literacy test. They failed. They had no literacy at all. We had some people who had a high level of practical literacy. Other people had more theoretical literacy, and other people who just really only focus on debt and equity. I explained those in more detail. We also reduced another 7-item scale through a principal component analysis, which ended up in terms of how reliable do you find information? And it ended up around unofficial information, so word of mouth, websites, tweets, social media, and the other one around official information, so more around the actual financial disclosures themselves and financial accounts, audited accounts. Quality information was a 12-item scale. Again, we reduced that. And we looked at basically 3 factors came up. How I really trust the information that is provided by charities. Another one was I really don't trust the financial information of charities. And the final one is, look, it's really too much of a hassle leaving law. And then the final one, obligation of charities to disclose. Again, we try to reduce because we've only got 400 down to two factors. Charities have a public duty to disclose, or another view is, no, actually it's private, they don't need to disclose. So that's the independent variables. This is the regression. Would it help if I just went, it's good? But basically, quite a series of strong things. Unofficial information didn't work, but official information did. Really, there's a positive correlation between decision usefulness and having official information, the public obligation, but not private data. No real surprises here. That if you trust and care about the information provided by charities, there's a strong correlation between that and decision usefulness. If you didn't care, we don't trust. Don't care actually did come through, and there's a literacy cluster, which I'll talk through in a second. So much of what we were predicting came through. In terms of financial literacy, basically, so I need to go through by DV because there's multiple DVs. In terms of financial literacy, organisational effectiveness disclosure, and spending on objectives was the 2 key things. So respondents who considered financially literate were more likely to consider these items important than those with no financial literacy. But what they're really interested in, those people who seem to be financially literate, what they were actually interested in was, have you spent your money on your objectives? So it's actually the use of the money. And the second one was, have you disclosed how effective you were? So it's actually the non-financial stuff in some ways. So have you met your objectives? Which kind of makes sense. If you're financially literate, you can read the finances, but you want the other stuff as well. In terms of, I'm trying to look at what I did, which is very quick. Answers and variables in terms of preferred communication, official. So I've just done a summary table. There's far more detail here. But basically, if your preferred way of communicating was official, then that was significant in terms of disclosures around organisational effectiveness, spending on objectives, net surplus, policy accounting standards, your spend as a percent of income, cash in and cash out. In other words, a high predictor of financial disclosures. Perceived trustworthy was really related to organisational effectiveness disclosure and follows the accounting standards. Even those who said they really don't care, really wanted to know that they follow the accounting standards. So there seems to be this signalling process, perhaps around through audits. So there's this seems like a signalling going on. Even if I don't really care, have you done the right thing still becomes important. In terms of the nature of public disclosures, again, public obligation was a big predictor. So in terms of the hypotheses, the higher the donor's financial literacy, the greater the perceived income. Partially, the focus really was on spending money on mission and effectiveness only. The higher donor's trust, well, again, partial. It's really around organisational effectiveness and following the standards only. Donor perception of information, or partially, all of the DVs, with the exception of follows the for-profit standards, were correlated to having the source of information was really important. And the final one was around the donor perceiving an obligation to report. Again, partially confirmed all DVs apart from spending as a percentage of income. So most of it was, and I'd just like to thank Ushi for being able to, Ushi for being involved in this. And even those who said they don't care, still want the standards followed. Thank you.
Thanks so much. And so our last presenter for this afternoon is Abhijit, who is presenting on audit research in Australian charitable organisations, a review of the literature.
Good afternoon, everyone. My name is Abhijit, and I completed my PhD from UWA last year. So my research interests include running experimentations to study auditors' behavior. So I use psychological theories and experimentation to study auditors' behavior. So this project is about charities. We are trying to develop a research agenda for audit for charities. Mostly we'll be looking at the medium and large charities. So I will be reviewing some literature. In this presentation, I selected some literature from top tier journals like Accounting Review, Contemporary Accounting Research, and try to come out with some research questions. But these research questions are still very broad. We need to narrow down and we need to do some empirical study. So first the introduction, then the audit research, what's the charities and research themes and questions. So these are some key stats. In Australia, there are about 60,000 registered charities. Charities have annual revenue of 176 billion, and that is like 8% of Australians' GDP. So donations rose by 8%, and expenses also increased by 10.2 billion. And there are 50 largest charities by revenue accounted for 33% of total sector revenue. So this is taken from the SCNC website and the Treasury. So here we're talking about the three tiers: small, medium, and large charities. For small charities are those with annual revenue under 500,000. Medium charities are those with annual revenue 500,000 or more, but under 3 million. And for large charities, this annual revenue is more than 3 million. So for large charities, the audit is compulsory. And for medium charities, the SCNC requires your financial reports to be either reviewed or audited. But for large charities, the audit is compulsory. So we are talking about the financial statement audit here. So why it is interesting to examine? So first, we have the sector neutrality. In a sense, it guides the development of Australian accounting standards by formalizing the concept that any transaction, regardless of the sector in which the transaction is generated, should be accounted for informally. So this creates a problem. So we need to have a separate standard for not-for-profit, for charities and not-for-profit sector. And there is interest among the academics, practitioners, standard setters, and regulators. And also, this area is underexplored. So we have identified two themes. Under themes, we have formulated some research questions. And these are some references. So the first theme is on effectiveness of governance in contributing to financial reporting quality in charitable organizations. So under this theme, our first research question is, to what extent are governance mechanisms, it can be audit committee, internal audit function, effective in producing quality financial reports in medium and large Australian charities? So quality financial reports make a free from material misstatement. the financial report statement should be free from material misstatements. And the second question is, how are audit committees of medium and large charities in Australia related to each other? If they are related, do those relationships represent risks and opportunities or both? So this question is very interesting. If we have some data, we try to get the data from the ACNC website and do some empirical analysis. Our second theme is audit quality in charitable organization. So are audit related factors? It can be audit firm size, audit specialization, audit firm, because this is a very broad question. We still need to narrow down. Associated with the achievement of quality audit in medium and large charities in Australia. Is there evidence of earnings management in medium and large charities in Australia? This is a very interesting question. We have some evidence. And in Australian evidence, I think one of the David's paper, there's some evidence. And in US, there are 2 studies was published in Accounting Review, looked at expense misreporting. So I will discuss a bit that. The third question, do sophisticated donors discount accounting information if audited by Big 4 auditors, if audited by non-Big 4 auditors rather than Big 4 auditors? It's also a very interesting question to explore. And is there any difference in audit quality between pro bono, low bono, and commercially priced audit for medium and large charities in Australia? So we are looking at these 6 questions, but still we need to refine, we need to scope it down to do some empirical analysis. And some research questions we need to either do a survey or interview to get the result. So our first research question is, to what extent are governance mechanism, audit committee, internal audit? So audit committees are expected to play a key role in improving financial statement integrity. And as a consequence, reduce audit risk. The company's reporting conformity with regulations can have an AC that appears effective, but it is not actually effective in substance. So we need to investigate those things. So this is one paper, which is published in Accounting and Finance Journal. So they have surveyed audit partners and managers to identify the indicators of actual audit committee effectiveness versus the auditor chosen list. So they hypothesize a negative association between the audit committee effectiveness and audit risk. And they found only when the auditor chosen list, rather than the extent of conformity and regulations, is used to measure effectiveness. So results supports their expectation. One is regulation based, one is auditor chosen list. So their result supports their expectation that audit committee effectiveness is measured like using ASX data list of recommendations and using a list of characteristics that survey auditors rated most highly as a group. So this is one paper. Based on this paper, we can formulate this research question. We further need to scope it down, we narrow it down. The second paper, I took it from the Accounting Review. So they looked at 2 measures of financial reporting quality: financial restatements and discretionary accruals, and 2 measures of external auditor oversight, audit and non-audit fees. So the authors find that the audit committee members who are both accounting and industry experts perform better than those with only accounting expertise. Is their finding. And they also find in certain instances, supervisory experts who are also the industry experts perform better than supervisory experts alone. Overall, these results suggest that industry expertise, when combined with accounting expertise, can improve the effectiveness of the audit committee monitoring the financial reporting process. So this is an American study. It's got published in Accounting Review. The second study is a JAR. They published in JAR. So they examined the interactive model of internal audit function. Internal audit function quality comprised of competence and independence to better understand the determinants of IFF, like the internal audit function effectiveness as a financial reporting monitor mechanism. The test supports the hypothesis that the joint presence of competence and independence is a necessary antecedent to effective internal audit financial reporting monitoring. In sum, the results show that the answer to financial reporting quality depends on the independence and competence of the internal auditor. So these are more like literature, most support from the Accounting Review, and this paper is published in the Auditing Journal of Practice and Theory. This is also an A-star journal. So in this Krishnan paper, they looked at the legal expertise. So using two financial reporting quality measures, accruals quality and discretionary accruals, the study finds that the presence of directors with legal backgrounds on the audit committee is associated with higher financial reporting quality. These results obtained after controlling for accounting expertise on audit committees. This paper looked at there's a significant negative association between financial reporting quality and the number of audit committee chair positions and the other committee financial expertise positions held by the committee member chairman. They found a significant negative association between financial reporting quality and the number of audit committee chair positions and the other audit committee financial expertise positions held by the audit committee financial experts. So these are some important literature. By analyzing this literature, we can formulate a research question. For this research question, I don't have any literature support. So we still need to reframe or revise this question. Our third research question is, are audit related factors, audit firm size, auditor specialization, audit partner tenure? So each question can be divided, and we need to narrow it down. Associated with the achievement of quality audit in medium and large charities. So this article is published in the Contemporary Accounting Research, and they examine the relationship between the audit partner business and audit quality. Audit partner business and audit quality. So their argument is the busy partner does not devote sufficient time to properly audit his average client. But contrary to these studies, the authors argue that when business is optimally chosen by the partner in equilibrium, there is no causal relationship between the audit partner, the business, and the audit quality. So this is an Australian study. The second article is also published in CAR, Contemporary Accounting Research, and this is an American study from US evidence from the not-for-profit sector. So they are looking at audit partner tenure and internal control reporting quality. So this study examines the effects of audit partner tenure and audit partner changes on internal control reporting quality for large not-for-profit organizations. Regulators contend that audit partners lose their objectivity oversight. over successive audits, reducing audit quality. So they found the quality of internal control reports and the severity of reported ICD actually decreased. Negative association between audit partner tenure and incidence of reported ICDs, the quality of internal control reports, and the severity of reported internal control deficiencies, that is the ICDs. So this is also a article published in the AGPT. So the study examined the effects of several audit-related factors on non-profit financial reporting quality. So the authors consistently find that specialist auditors and unexplained audit fees have a significant positive effect in financial reporting quality in non-profit organizations. We come to research question 4. Is there evidence of earnings management in medium and large entities in Australia? So one of David's paper involving 154, it is from the disability services. The study found that the sector is subject to earnings management, that such activities are aimed at reducing the reported profit, likely in order for these organizations to meet the normative financial expectation of stakeholders, including public sector funders and philanthropists. So they are reducing the profit to attract the funding. So that means they are they are showing loss. In fact, there is a profit. And this paper is published in Accounting Review. It is based on expense misreporting in non-profit organizations. It's an old paper, but still it is very relevant. So empirical evidence that the zero fundraising expense phenomena is at least partly due to the inappropriate reporting. So the study examined to what extent these misreported expenses are the result of managerial incentive. So the prior research finds an association between reported expenses and managerial compensation, as well as the level of donations received. So using these findings, the authors construct two incentive variables and find a positive association between misreporting behavior and managerial incentives. So this article also looked at institutional pressures to provide social benefits and the earnings management behavior of not-for-profit. So it is also published in Contemporary Accounting Research. So their findings suggest that due to competing private incentives to report higher profits, non-profit managers practically use discretionary accruals to increase accounting earnings when the social benefits their firms have provided in the current period exceed external shareholders' normative expectations. So this is our fifth research question. We're talking about whether the sophisticated donors discount accounting information if audited by non-Big Four auditors rather than Big Four auditors. So here is a very latest paper published in Accounting and Finance, and this paper published in the JAR. So in this paper by Simnet and Carson, the findings show that about 4% of charities receive going concern opinions, and these are more likely for those which are smaller in greater financial distress. Received a prior year going concern opinion, and are also affected by dependence on the various types of funding received. So after controlling for these factors, the Big Four auditors are less likely to issue going concern opinions than other audit firms, but there are no differences in their association with subsequent revocation. And the next article focuses on the economic consequences if financial audit regulation in the charitable sector. So this article provides evidence on the effects of financial audit mandates in the charitable sector, in particular their influence on donor behavior. So consistent with audit mandates, reducing donors' reliance on charity reputation. The findings show audit mandates are stated lead donors to shift part of their donations to a smaller, lesser known charities. So this is the main finding of the author. So we have another paper, like it's 20 years ago, but still it is published in AGPT. So this is also worth considering for the literature review. And our last research question, whether there is any difference in audit quality between pro bono, low bono, and commercially priced audit for medium and large charities in Australia. So I found only one literature, because a very new publication published this year. So this study finds that pro bono audits are mainly supplied by Big Four auditors to charities with greater public donations and a lower debt ratio and operating in multiple locations. So no evidence of impaired audit quality when comparing pro bono audits with non-pro bono audits. For non-pro bono audits, audit fees are significantly associated with size, complexity, revenue sources with premiums paid to larger audit firms. So yeah, I think that is my presentation.
Thank you. Right, thanks so much to our presenters, and I'll open the floor for questions. Does anyone have questions they want to ask? I know I do, but I don't hold it, so.
I'll go for one. In Michael's presentation, the part about income recognition has a really interesting phrase in it, which talks about the income being recognised when the resources have been transferred out of the organisation. To me, that's matching principle, isn't it?
It is. So there are. So the AASB 105A moved away from the matching principle, and it just talked about the control. But this new standard does move a little bit back to that in terms of having that common understanding of what are the requirements of the funding agreement that you basically match the income against when the expenditure is expected to be incurred. So it is it's really interesting.
It's interesting. It's not using the phrase matching principle to me. I just thought that was worth raising.
So even with a couple of those things, I think we're finding it's sort of going around a bit of a circle.
Yeah.
You know, the times change, so they go, well, we don't want to do that anymore. But then a little bit later, it's like, well, maybe we do, and then we don't, and then we do. So yes, we're definitely coming around full circle, I think, in some of that.
Fantastic.
And do you think those changes are enough, like what's being proposed?
Look, it depends how they work in practice, because, you know, as I said, sometimes, you know, going back to say the old income standard, you know, the concept is really, really good. The concept actually works. It's then when you put it into practice. So I guess with this new one, we've just got to see what happens. But I think it probably is. I don't think we should go and change everything. Because as I said, we're already moving towards this different framework. And so I guess we've got to see, well, how does that impact? You know, then it comes back to the point about financial usefulness and decision making if you've got a completely different reporting framework. So I think at the moment it is enough, but we'll see where we go, I guess.
Yeah, my question's really for Ushi and Craig. It feels to me like there's some utility for ACNC in understanding what donors want to see or can usefully take into account. So I'm just wondering what you might see the practical application of your paper being.
You want me to do that? Yeah. Okay, practical application obviously will be, you know, to inform standard setters and regulators about it. We kind of I kind of did present that paper a bit differently, not with Craig's statistical magical hand in there, doing those wizard things he does with stats and numbers, but just for a bit of a non-academic audience. So try to keep it simple with just simple bar charts and everything. And but WSB did reach out to say they were very interested and they wanted to know more about all this information. So I do see, and I hope, it would have some policy implications, because that's the only way we can really help the sector. There's one side of doing this research and publishing and ticking your box with your supervisors and your school and everything. But I think what motivates us is mainly, trying to have some impact and help the sector to really channel the energy, because they don't always have resources to channel that, really focus on the information that people need and want, and eventually, be able to have more support from people.
Yeah, because I think that whatever your personal views, the purpose of enhancing the charity register as it was actually to put a bit of like for like in there, so that you can kind of see across the board, and also kind of give a one location, so that when you do a search, you can do it there and come up with all of the charities that might suit your needs. But it does seem to me like there's still a lot more that we can do to actually make it useful and readable. And I know, so David Crosby, for instance, has written about, don't just look at the financial information, which, I agree with, but then you've also got to be able to lay it out, I think, in a way that is actually useful, so that people with varying degrees of literacy can understand it. So I'm also putting my hand up as being interested.
Thank you.
So I think this, can they understand, do they trust the information?
Yeah.
Can they read the information? And I think one of the big takeaways is, even if they don't care and they can't read, is it audited? So if there could be a flag somewhere that it has complied with the standards, simple, that might not be able to read it, but that might be something useful.
Yeah.
If it's not with the standard, I don't know. I think if the ACNC can go, okay, we've double checked, a few things, tick, that could still do the job, Yeah.
Yeah. Well, we review 250 jobs a year, and there's so many that have been audited, and it's not all there. We just go.
I feel like there's a conversation about where does each individual source of legitimacy come from? Am I happy with a proxy of someone certified saying it's legitimate, and that's enough for me?
So do we trust the auditors, or do
Yeah,
we trust the ACNC, or do we trust?
But that's also a literacy problem,
Yeah.
expecting that the auditor's tick actually is
But enough
Yeah,
or
it's-
satisfactory?
it's, audit's not about that. And I think one of the big returns on investment for all of this research is, what can we do to raise the bar in terms of people's understanding? I think the real risk of regulators is that they actually lower the bar so much that we oversimplify and that's worthless. Anyway.
Yeah.
So I think it's an important balance to try and keep.
Yeah, I agree, because I think even though the primary stakeholder group is all the charities, also trying to talk to the public as well.
Yeah.
I think everyone in this room understands that, don't kind of understand all the nuance of financial reporting and the charity laws.
Absolutely.
Yeah, I agree. So David, was that your
No,
question, or I can come back
I
to you?
didn't wait for you.
Oh, that's fine. Oh, I interjected anyway. Alex.
Can I follow up with that? Do you have data from the usage of the registered website that tells you how users are going in and what pathway they're following? So can you see if they look up a charity and then they go to which pages they go to, and then do they go to its AIS, do they go to its financial statements? Is that data available from the registered website? Because that might give us really interesting insights into what information they're actually looking for.
Yeah, another big thing that has to happen is get financials out of PDFs, but that will be,
Yeah, we'll get there. And how long did it take the US to do that? Come on. We'll get there.
But I think the interesting thing about that is, I knew somebody who actually did that on a charity website, and they went in, they looked at their causes, they went to their financials, they didn't open them, they just went,
They were there.
they were there,
Yeah.
and then they went to the donation page, so they
Yeah.
followed the cookies.
Yeah.
But
That data should exist. Like that's fairly basic website training.
yeah, it's just that that's not a question I had.
So that might be a really good data source to try and, triangulate the findings from your survey to say, well, hang on a minute, I'm going to have a look.
But I think it's a good conversation to have about what's enough for me, what's enough to satisfy me kind of thing. And to appreciate there's not going to be even playing fields of financial literacy, but if you can still establish a level of trust because of other channels, then maybe that's, enough. I'm supposed to let you all go because at 5:30 there's a session downstairs.
That's right.
But if you do have more questions, please, and I've got questions for you.